Hello, everyone, and welcome back to the Cedi Investor. In today's episode, we are going over the banks, the banking sector. I want to go over the performances of all the banks over the past 9 months. And at the end of the video, I also want to give you my thoughts on the bank I think is the best risk adjusted bank. Now, when it comes to investing, we are not looking at just the reward, the returns, or the capital appreciation, or even dividends that you receive from the bank, but we are also looking at the risks. I even feel like that part is more important than the return, because if it was not for the risk level, then we can essentially just invest into anything. We can, just even gamble with the money. So you have to make sure that you've positioned yourself in a situation where your money has the least risks. The possibility of you losing your money is little to zero. We have a lot to discuss, so let's get into the video. So we'll start off with Ecobank. Looking at their income statement, we can see that the bank's net interest income went down from 2.5 to 2.1 billion Ghana cedis. And that's one key concern I had. I said that banks were heavily reliant on government securities. And now that we are moving towards a low interest environment, that can really hurt them, especially if they are not, adapting, trying to loan out more, or, being creative with the types of securities they invest in. And we can see that hurting them. But overall, they ended up having a positive net income, going from 900 million to 1.4 million. And we can see that the main reason for that was their net trading income, which went up from 315 million to 1 billion Ghana cedis. Their cash position also grew from 16 billion to 19 billion. And we have here loans and advances also growing from 10 to 12 billion. Deposits from customers also grew from 33 million to 34 million. So that's good to see. We also have the capital adequacy ratio going from 13 to 15, which showing that the bank is becoming more strong and resilient. And the non-performing loan went from 17% to 20%. So that's not really a good sign. We want to see that figure coming down. I'll say it's an average performance by Ecobank, and they can definitely improve upon that. Up next, we have Access Bank, and I would say their statement is quite confusing, because the main thing I was focused on for the banks during this particular year was net interest income. And we can see that Access Bank's net interest income went up from 333 million to 437 million, which is very, very good. But the reason why this is quite concerning is that we are seeing their earnings per share dip from 3 Ghana cedis to 2.5 Ghana cedis. And the main reason for that is that their net fees and commission actually went down from 560 million to 400 million, which is quite concerning, because that was not really a concern for banks coming into this particular year. The main focus was net interest income, assuming that interest rates continues to fall and we shifting towards a lower interest environment. We are going to assume that banks will find it difficult to, make the same amount of money they were making last year, where interest rate was quite high. And what's interesting is that if you go into the balance sheet, we are seeing deposits from customers go up from 30 million to 40 million. So their deposits are actually increasing. So from seeing this, you can make the assumption that customers are using more of their services, and that should translate into more money being made through fees and commissions. Loans and advances to customers went up slightly from 3.1 to 3.5. Investments in securities went from 5.7 to 6.2, and cash position went down actually from 5 billion to 4 billion. Also, their capital adequacy ratio went from 18 to 16. The 16% as a level is good of a capital adequacy ratio, but it's going down. It's not really a good sign. If you won't even go up, I want you to maintain or stabilize. So to see it coming down is not a good sign. But one thing that I have to give to Access Bank, I really, really like the company's non-performing loan. I think it has the best in the banking industry at the moment, to loan out about 3 billion plus and have a non-performing loan of about 3.9. So the number of people that are defaulting, very, very, very low. So I have to give it to them. That's pretty impressive. Moving forward, we have Societe Generale. and their net interest income, it went up. Net fees and commission also went up as well. And the company's, earnings per share, it grew from 0.5 pesos to 0.65 pesos. So that's good to see. Their loans and advances, however, went down slightly from 4.8 to 4.3 billion. Investments in securities went up from 1 billion to 2.3 billion. So they are investing heavily in securities during this period. Cash position was relatively the same, around the same level, and we have customers deposits from customers also relatively the same, from 6.1 to 6.2 billion. Looking at the key performance indicators, capital adequacy ratio went up, non-performing loan ratio went down from 19 to 13%, very, very good. And the liquidity ratio going from 90 to 109. That's pretty impressive. For Republic Bank, when we look at their key quantitative disclosures, it's relatively the same compared to last year. Capital adequacy ratio went up slightly, 15 to 16.7. Non-performing loan went from 16, it went down slightly, from 16.5 to 16.4. So it's going down, but relatively around the same level. Liquidity ratio too as well, very good, but around the same level. So they are more stabilized compared to what they did last year. They ended the year with an increase net profit from 140 million to 202 million. And we can see the main reason for that being the net interest income going from 440 million to 543 million. And finally, we end off with Standard Chartered Bank. This bank, I think, is one of the most overvalued bank on the Ghana stock market. And it doesn't really reflect in the numbers of the company. Their net interest income went down massively from 1 billion Ghana cedis to 775 million Ghana cedis, a massive decline in the net interest income. When we go further, you will see they did something very similar to what Bank has been doing, where they had a net impairment on financial assets being positive 36 million, meaning the money they set aside for previous losses, they were able to recover some of it to support their statement. And they ended up having a positive operating income of 1.4 billion compared to 1.3 billion. But still, because of their heavy expenditures, the profit for the first 3 quarters was 508 million compared to last year was 574 million. But because of net gain from changes in fair value of their investments, they ended up having a total comprehensive income of 594 compared to 541 for last year. But the interesting thing about this is when you look at their earnings per share, you can see that it's still less compared to last year. It's now 3.7 Ghana cedis compared to 4.26 Ghana cedis last year, meaning that the company has done some sort of dilution. Loans and advances to customers was slightly lower, 2.3 to 2 billion. Loans to other banks went up actually from 500 million to 1.6 billion. And we have investment in securities also going down from 7 billion to 5.4 billion. Now, finally, after going through all these statements, which bank do I think is the best risk adjusted? The bank that is in the best position for return, but also its risk has been minimized. And we have it right here. I believe GCB is the best risk adjusted return bank at the moment, followed by Ecobank, Bank, Republic, Societe Generale, Access Bank, and the bank I feel is the least risk adjusted at the moment is Standard Chartered Bank. Now, how did I come up with this? We have the share price of all the companies, and we are going to use GCB as an example. For GCB, the current share price the company is trading at is 18 Ghana cedis, and I believe its fair price is 19.78. Now, you can have a different opinion as to what you think the actual fair price of GCB Bank is, but this is based on my assumption. So in this thesis, there's a lot of assumptions being made. The current earnings per share for GCB is 6.53, and its current PE ratio is 2.7. Now, for a PE ratio of 2.5, GCB needs to have an earnings per share of 7.9. And remember, its current earnings per share is 6.5. So how much should GCB's net income grow by to be able to get me the earnings per share of 7.9? And we can see that GCB needs to grow its net income by 59%. If that happens, it should be trading around the fair price of 19.7. Now, after determining how much GCB needs to grow its net income by, the final thing is determining how long you think the bank will use to be able to grow their income by this. And based on how GCB has been growing, I believe that it will take about 1.5 years or 1.5 years to be able to grow such an income. So if all these things plays out, which does not necessarily mean a war, but should these things play out, it is worth it for me to buy GCB at its current price. I hope what I explained makes sense. And I did the same for all the other banks. What I think their fair price is, what their current earnings per share are, what I expect their current earnings per share should be, based on the PE ratio that I'm willing to purchase or I'm comfortable in buying these particular companies, which for most of the banks is 2.5. For Cow Bank, it's a little bit lower because of the risks with that particular company. The highest I'm willing to buy Cow Bank would be 2, the lowest at a P ratio of 1.5. So basically, I'm willing to pay 1.5 times the current earnings of Cow Bank. So I don't want to go through everything. You guys can maybe pause the video and go through everything. But we can see how much each of these companies should grow their net income by to be able to match my expectations of where their fair price should be trading at. And also, I have here all the years I believe it will take for each of the companies to be able to grow their net income to those current levels. Now, before I end this video, I just want to say that these are all assumptions. And because I even believe this company's fair price should be trading at these particular levels, does not necessarily mean that they are going to be trading at these levels. And also, finally, the main reason why I'm not willing to spend more than 2.5 times the current earnings of these companies is that I've realized that the banking space in Ghana is heavily reliant on government, especially government securities, and there's a lot of risks involved. We all saw it during DDEP. There's a lot of things that can really affect the banks going forward, especially if the macroeconomic environment is not really conducive. So I'm not really willing to, pay premium value for banks. But that is the end of this particular video. Thank you so much for watching. Let me know what you guys think. I really appreciate it. Comment down below, like the video, subscribe. I really appreciate it. Until we meet again, have a lovely and blessed rest of your day. Peace.